So when you're sitting with your accountant, have you glossed over at certain accounting terms? Follow my video and I'll explain what these are. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. So are you a construction business owner and in the meeting with your accountant, are you just glossing over with accounting terms? This video will explain what these mean. Assets within your business are defined in two areas. The first one is fixed assets. A fixed asset is something that you can physically own, touch and feel. Now, for a construction business, these are likely to be plant and machinery that will last more than 1 year. It would also be vehicles, which could be vans and cars. It could be buildings, and it could also be furniture and fittings, which are within your office. All of these are defined as being as a largish item and would last more than 1 year. Other assets in your business are known as current assets. Now these can be a variety of things. The big one normally is accounts receivable. This is what you've invoiced your customers but have not yet been paid for. This is recorded on your balance sheet as a current asset. Other assets within your business could be prepayments. Now, prepayments are where, from an accounting perspective, the cost is recognised when we receive the invoice. But if some of that is prepaying for stuff in advance, so a classic is insurance, you pay for your insurance a year up front, but this straddles your year end, you will have to carry forward some of that cost against the following year. Because what we do when we run accounts is we match income against costs for a period that they directly relate to. The other asset in your business will be cash at bank. So what have you got in your current account and what have you got in your savings account? So to break it down, assets in a business are either fixed assets or they're current assets. Liabilities. This is everything that the company owes to various people or organisations. You tend to classify these in two areas. One is current liabilities, which means that this liability is payable in less than 12 months, or you have a long-term liability. Current liabilities. Normally the big one within current liabilities are accounts payable. This is also known as trade creditors. In the accounts, we recognise a cost on an invoice basis. Now, if you've got that on credit terms, which could be 30, 60, 90 days, whatever you negotiate, this will be sitting there as a liability on your balance sheet as the money has not left your bank account. This is a really cool way of helping with your cash flow, but also any money that is owed to your suppliers is interest free. So without taking the Michael out of them, make sure that you are using this to its optimum as it's cheap money. Long-term liabilities. Long-term liabilities are normally going to be for a mortgage or if you've got a loan that's over a year. Whatever part of that is classified as being payable in year 2 and forward will be put down as a long-term liability. One account as well, which is commonly referred to a long-term liability, is money that you've invested in the company that's sitting in your director's loan account. So if you've got a big credit balance, which means in layman's terms the company owes you money, you have an opportunity to classify this as under or over 1 year. A lot of businesses we work with sometimes have big credits in their director's loan account and will classify that as over 1 year because they expect to get it in 2, 3, 4, 5 years time. But this is a judgment that you've got when you sit down and talk with your accountant. Okay, thanks for telling me all this stuff, Michael, but what really is a balance sheet? A balance sheet in layman's terms is where you take a picture of all your assets and all your liabilities at that given time. So if you're doing a balance sheet as at the 31st of December, it will have every asset and every liability showing the net worth of your business. And just remember, costs and income are recognised when invoices are received and posted onto your system, not when it's paid out of the bank. The true reflection of how well a company is doing and how well it has done in the future will be its closing balance sheet, because it will show black holes and problem areas within a business, especially if it's undercapitalised. An income statement or a profit and loss account. This is income less costs, which we normally define as direct costs and overheads equals profit. Now, when I was training, we always referred to it as a profit and loss account, but now we've implemented international standards, it's known as an income statement. Let's be honest, they are both the same thing. They are a scoreboard of how well your business is doing in the year from a profit basis. A lot of people can hide behind various numbers that, oh, my turnover is brilliant. But yeah, that's all very well and good, but you're in business to create value and make money. So your income statement or your profit and loss account tells you exactly how well you're doing for that year. Now, it is possible from a management account perspective to have shorter income statements for a period, and that's fine. But when you're looking at a standard company set of accounts, this is on a 12-month basis. One thing to be mindful of as well, if you're comparing data, which you should always do, is be careful that you're comparing 12 months with 12 months, because it's easy for a company to change their year end. Just make sure you're comparing the same period with the same period. It's a trap people fall into. Depreciation. Earlier on in the video, I spoke about fixed assets. And these are defined as something that's significant in value that's going to last more than 1 year. So an example I'm going to use is a computer. So if you buy a laptop, that's going to be a physical asset for the company. So if you buy a laptop for, say, £1,200, I would normally classify it would last 3 years. And you could easily argue that a laptop could last 4, but I always do it over 3. So what you do for depreciation is you chop up the bit that you've used throughout the year. So in year 1, if you did it on a straight line basis, which is a third, a third, a third, you would then put £400 into your profit and loss account for that year. That £400 will go down as an expense, which reduces your profit, and that other side of the £400 would reduce your asset that's sitting in the balance sheet. So by the time that you get to its useful life, which is when you're expected to be knackered, and trade it in for a new one, the balance should be sitting on your accounts as 0. It's not an exact science, it's your best guess estimate, but depreciation is a way of taking an asset that's sitting in your balance sheet in fixed assets and reducing it down to its useful life. A planning point for, especially for construction businesses, is being mindful of when your assets need replacing, because plant, machinery, tools, everything is capital intensive. So bear in mind when you've got renewals, because this is you're gonna need to make sure that investment is in your business, because you'll need the cash flow to fund it. I hope this video has really helped, and if I can be any further help, if there's any questions you've got, jump on a discovery call with me below. We can either chat on the phone or Zoom. I'll take on board any questions you have. I promise there'll be no pushy sales pitch.